Good morning, everyone. Welcome to our webinar on some of the small business financing initiatives underway at the ASC. I hope this finds everyone doing well wherever you're watching today. Thank you for taking the time to join us. My name's Tom Graham. I'm the Director of Corporate Finance here at the ASC, and I'm going to be the host for this morning's sessions. I'm going to start by introducing our guest panelists. We are most fortunate to have with us today two members from industry who are very familiar with the topics we are discussing and specialize in the exempt market and small business financing. Joining us today are Sandy Gilbert and Phil Delhomme. Thank you to both of you for taking time out of your schedules. Sandy is CEO of two organizations active in the private markets, Intergen and DealPoint, and she's on the board of, and actually the former chair of, the National Angel Capital Organization, NACO, and she's also a member of the ASC's new advisory committee. Phil's a capital markets lawyer who specializes in and has a very active practice dealing with exempt market issuers, both on the dealer side and the issuer side. He is a director and a member of the executives of the Private Capital Markets Association. And Phil also gives us his time as a member of the ASC's Exempt Market Dealers Advisory Committee. It's also a nice balance in that Phil is from Edmonton and Sandy is from Calgary. We talk about capital formation being different in different parts of the country, but I think we found that there can be a different experience between Calgary and Edmonton in terms of capital formation within the province. So it's nice to have both those perspectives. Today, doing the substantive work, I'm joined by my colleagues here at the ASC. Denise Weirs is the director of our New Economy Group. Kathy Tiro is senior legal counsel in our New Economy Group. And Navdeep Gill is our manager of the legal group in market regulation. When it was suggested that I host today, I felt like a bit of a freeloader as my colleagues really have done most of the work here. That said, Denise and I have worked for some time together. I've had the good fortune of working with her, and she knows my capabilities, or more to the point, my limitations. I asked her, I said, what can I do for you in this webinar? And she said, well, can you find at least the top half of one of your suits? And I said, yes. She said, would you be able to tidy up your office? And I said, yes. And she said, well, you're in. So I do appreciate their leadership on this, but hopefully it reflects the work being done in our New Economy Group is being done in close collaboration with our customer or market-facing groups, such as, in my case, corporate finance and the issuers, or for Navdeep and his colleague Lynn Satsumi, market regulation with the dealer oversight. We really have a great turnout today, notwithstanding the fact that everybody wants to get back to more normal interactions and in-person operations. Since the pandemic began, these webinars have had far better attendance than our previous offerings, even when those offerings had both a live component and a webinar component. So, and it's not just a result of the pandemic that we're doing these webinars, but also part of a more deliberate strategy to try and find ways to make policy process less, or the policy process less formal, less intimidating, and more conducive to getting feedback. You know, the formal process of where we publish a 100-page document and ask for written comments, it's sort of like getting homework on a Friday and being asked to submit it for Monday. But hopefully these types of forums, with them we can try and more quickly highlight some of the issues and the thinking behind them, and can help you kickstart that comment process, which really is important to the ultimate policy implementation. There are a number of significant other policy projects coming down the pipe, and I expect we'll use this approach to help facilitate the word on those as well. So thanks to our Dynamite Communications team who make this possible. I think there's something here for everybody. I just want to briefly highlight the format today. For each of the three topics, ASC staff is going to take about 10 minutes and walk through the proposals and or, in Denise's case, the new rule. Then we're going to take questions from the audience for about 5 minutes. And then we're going to turn it over to Phil and Sandy to get their perspective from industry. In terms of the technology, you'll see at the bottom of the screen, the chat has actually been disabled, but there's the Q&A section. So if you want to submit questions, please use that function. We'll try our best to get to all the questions, but in all likelihood, we won't get through all of them. Any questions we don't get to, we're not trying to put them off, and we will circulate a Q&A that tries to respond to all the questions after this for anybody that was signed up. So without further ado, I'm going to turn it over to Denise, who's going to kick things off on the recently announced self-certified investor exemption. Denise.
There you go. Okay, thanks, Tom. I'm going to speak this morning about the new self-certified investor prospectus exemption. It was adopted effective March 31 in Alberta and Saskatchewan. It's available on our website under Regulatory Instruments 45-538. But before I dig into sort of the details on it, I thought I'd provide you just a little bit of background on some of the initiatives that were underway and how we got to where we are now. A few years ago, the Alberta Securities Commission, together with the other securities commissions in Canada, did a consultation on regulatory burden reduction, looking at ways we could, perhaps temper some of the requirements to reduce the regulatory burden. That consultation was really focused on the public capital markets. For us in Alberta, that meant hearing significantly from the energy sector, the oil and gas companies, the oil and gas service companies, and pipelines. But here in Alberta, we were also interested in sort of the efforts that were being undertaken to diversify the economy and wanting to understand that space as well, and whether there were things that maybe needed to be done differently or different considerations, and what we might do as a securities regulator with a mandate of protecting investors and fostering a fair and efficient capital markets, whether there was anything more we could do in that space. And so in addition, we undertook our own separate consultation, 11701, energizing Alberta's capital market. And we got a lot of good feedback from market participants on ideas of things we could do to help with the capital formation process. And we tried to sort of prioritize those, look at those that we can address on our own, those that are maybe longer term initiatives that we would be working on with our CSA colleagues. Some of the things we've done already, we rolled out some new website content. One of the things we heard was that it would be helpful to have some sort of plain language overview of the various ways that a business can raise money, the rules that they need to comply with. So we tried to provide some plain language content, answer some of the frequently asked questions, and to supplement that with videos and narrated PowerPoints. And that's something we hope to continue to build out to be helpful. We also heard that it would be helpful to have more information on other financings that are occurring. And so we launched 3 new dashboards on our website that really are searchable databases on financings in the province, both public and private, to the extent the private are reported to us. And you can look at what types of securities are being sold, what dealers are involved, what industries. And then we've been also looking at regulatory burden for smaller dealers. One of the things that we heard was that a lot of the challenges in capital raising are in the smaller deals, the under 5 million or under 10 million. To the extent a dealer is involved in that space, it tends to be a smaller dealer, so looking at whether we can reduce the regulatory burden for them. So some background on the self-certified investor exemption. So it's the first of the 3 initiatives that follow out of that larger consultation. As you may know or may not, the starting point in securities laws, if you're going to be selling your shares or other securities, is that you provide a prospectus, a comprehensive disclosure document describing your business, the business plans, and the risks associated with investing. And then once the company files that prospectus, it becomes a public company, a reporting issuer, and subject to ongoing disclosure obligations to support secondary trading. Of course, a prospectus is not an insignificant undertaking. It's expensive and time-consuming, and so too is being a public company. So securities law recognizes, that there's a need for prospectus exemptions. And the most popular prospectus exemption by far is the accredited investor exemption. And that exemption really allows wealthy individuals and institutions to invest without securities law dictating the disclosure document that has to be provided to them. So when we did our consultation, Energizing Alberta's Capital Market, what we heard is that we should also look not just at wealth as a criterion, but at the financial or investment knowledge of investors as a basis to allow them to invest. So, to qualify as an accredited investor, an individual would need to have either $200,000 net income, and they've had that for the last couple of years, or $1 million in net financial assets. So really, we're just looking at cash and securities, less related liabilities. So looking at people who don't meet those tests, but have this financial knowledge or investment knowledge. And that's really what we're trying to do here with the self-certified investor exemption. We also heard that in Alberta, we have, an investor base that's very experienced in investing in the energy sector, but that would be helpful to help build out the angel investor base to invest in sort of earlier stage technology companies. So this is a 3-year pilot project. We hope to evaluate use of the exemption, see if it's successful. If it works well, hope to convince our CSA colleagues to join us and to make this a national initiative, amending the accredited investor exemption. So what are the key requirements? Well, significantly, the exemption's only available in Alberta and Saskatchewan. So that means the issuer, the company raising money, needs to be headquartered in one of those 2 provinces, and the investors need to be in those 2 provinces. If you're raising money from someone in another jurisdiction, you're going to have to look at a different prospectus exemption. Just as there's no specified offering document for accredited investors, there's not one here either, but the investment does need to be made alongside an accredited investor, and the investor has to be given the same access to the same disclosure. A key requirement is the statutory declaration. So that means that the investor, within the last 36 months before investing, so they don't have to do this just at the time they invest, they could have done it any time in the last 3 years. They've gone before a commissioner for oaths or a notary public, and you're going to want to go to a notary public if you want to use this in both provinces. They've gone before one, they've solemnly declared that they've completed this acknowledgement form, they've done that so of their own choice, and they've truthfully completed it. As long as the issuer doesn't know, that's false, they're entitled to rely on that statutory declaration. So what's in that acknowledgement? It really does 2 things. One, it confirms that the investor meets certain qualifying criteria, and I'll come back to that they have that financial or investment knowledge. And the other thing is it confirms they've read and understood an 8-page sort of acknowledgement of various considerations when investing in sort of early stage companies, particularly those in the private markets. And then the last main criteria of the exemption is that there are investment limits, unless this is a listed issuer investment. And I'll come back to that also. So those investment limits are the investor can invest up to $10,000 in any one company in a year. And they represent to the company raising money that they haven't invested more than $30,000 under this exemption in the calendar year. So what are the qualifying criteria? There's various designations and degrees that would allow an investor to constitute a self-certified investor. So some of those include a CFA designation, or an accountant with a CPA designation, a chartered business evaluator, or a finance degree, business degree, as long as it has a finance or investment specialization. Lawyers can qualify, provided that their practice is at least 1/3 focused on public or private financings or M&A activity. And if you don't have any of those degrees or designations, it's still possible to qualify as a self-certified investor if you've successfully completed the Canadian Securities course, which is administered by the Canadian Securities Institute, and you have a certain minimum net income. So here we're talking about, for an individual, at least $75,000 net income, and you've had that for the last couple of years. Or if you don't qualify on your own, you can look at it in a combination with your spouse, and there the number is 125,000 net income together, and you've had that for the last couple of years. The exemption also contemplates companies, so maybe a family-owned company or a trust, and really there we're looking at are the majority of the owners or a majority of the board of directors self-certified investors or accredited investors. Now let's go back to that listed issuer investment. I said there's no limits if it's a listed issuer investment. So what is a listed issuer investment? Really there we're looking at a public company, a company whose equity securities, so probably their common shares, are traded on one of the Canadian stock exchanges, and it's in compliance with its disclosure obligations as a reporting issuer, not in default. And the investor has received suitability advice from a registered dealer or a registered advisor that that investment is suitable for them. If it's a listed issuer investment, then the investor is not just relying on that information they might get in the private financing. They have available to them all the information that's available in the secondary market. We don't need an arbitrary investment limit because they have advice from a dealer on whether it's suitable for them. I should just mention that if you've got a listed issuer investment, say you were a self-certified investor and you invested $40,000 in a publicly traded company, qualified it as listed issuer investment, and then you wanted to invest in a private company, that $40,000 doesn't get counted in your $10,000 and $30,000 calculations. So last final points. As with most prospectus exemptions, there's a requirement to file a report of exempt distribution with us within 10 days after the closing. That is required here as well, except in the case of private issuers. That statutory declaration and acknowledgement I mentioned, it's not required to be filed with us, but you should keep it. The typical resale restrictions apply to this exemption. So for a non-reporting issuer, that means that they continue indefinitely. For a reporting issuer, this tend to be 4 months. And then lastly, if we're talking about a private issuer that's raising money, a private issuer, here we're talking about an issuer that has less than 50 security holders. Generally, it's never sold as securities to the public. They wouldn't lose their status as a private issuer if they sold securities to a self-certified investor. And similarly, they don't lose their private issuer status if they sold their securities to a special purpose vehicle that's comprised of accredited investors and self-certified investors, as long as the self-certified don't constitute more than 25% of the funds contributed. So that's sort of the overview I was going to provide on that. Happy to take any questions. And if you have any later on, please feel free to email us at new.economy@asc.ca. Thanks.
Great, thanks, Denise. And just to be clear, this is now in place, and so we are looking forward to seeing what kind of results we have. And I think Denise mentioned the dashboards that we have, and I think we'll probably have a separate special dashboard just to track the take up on this. Denise, question for you here. Why 10K and 30K when investing in non-reporting issuers, but none for listed issuers, so long as the issuer gets advice? Question.
Yeah, well, when we're talking about a listed issuer, as mentioned, they have all of that, the investor has available to them all of the information that's available in the public market. So there's more information. They're not relying just on the private financing information. And, these are risky investments. We're talking about early stage companies. There's a high, failure rate, unfortunately, often. So, here we're talking about people who have, they have less than $200,000 net income. So looking at what sort of makes sense, we're hoping to encourage diversification, want people to get exposure to the space, but, not investing their life savings. So that's sort of the thought.
Won't happen again. Curious about why a statutory declaration and not just a representation or certification from the investor.
Yeah, I think, we wanted this to be an exemption that was used by motivated investors. So they wanted to participate. And, one of the concerns I think that's occurred in the past is that in some cases, people just have a stack of papers put in front of them, or maybe it's done online, and they're not really reading what they're, what they're signing. So wanted to make, with the statutory declaration, really wanted to bring it home to the investor, ensure that, we knew that they were actually reading this, and it wasn't just lost in a bunch of other papers.
Okay, time for another one here. What is the prospect of having this be a national initiative?
Well, we're hopeful. Our colleagues in the CSA have expressed interest in it. We've shared, sort of the background with them. We shared with them the comment letters we got when we published it for comment, and we will be sharing with them sort of the feedback we get on it and on the use. So, we're hopeful. We see that harmonized initiative across the country is more beneficial for our capital market. But I guess time will tell, and we'll see how well the exemption is used.
I think that'll be an important part of it, is to what extent it's used. And one additional question in regards to the notary, and Someone says this might be a question for a notary, but is an e-signature acceptable for the stat deck?
I don't know. I don't know if Phil knows. We'll have to look into that.
These aren't, you know, stump the presenter questions. These are, you know, supposed to be questions we can answer, and that's rarely happens with Denise. So perhaps that's a good segue to turn it over to Phil and Sandy, and we'd love to get your views on this. I've got some more questions here, and we will, like I say, put together a Q&A and distribute it so that we don't miss any of these, or if we have time at the end, we can come back to them. So Sandy, Phil, I'm going to let you guys take it away.
Right on. Thanks, Tom, and thanks for having me. And also, you know, kudos to the ASC for taking a lead on exploring some of these solutions that might help support the funding gap that a lot of small businesses and early stage companies have. It's nice to see you guys taking the lead, and let's hope the rest of the country will follow. Well, I mean, anybody that knows me is going to say that I like this exemption. I think that part of the goal within NACO and really the early stage ecosystem is to find kind of the net new angel investor. And what a better way to introduce these young professionals into the asset class alongside other investors that are making the investment there. So I like it. I'd also like the limits to be higher, but we'll work toward that. And I think maybe there's some conversation around adding different qualifications, perhaps in education or something down the path as well. Phil, I think we're going to use this a lot in the early stage space. Do you see any of the EMDs using it in the regulated market?
It's a good question, Sandy. And you know, I think that there will be a certain amount of reticence from the EMD space. We'll probably talk about it a little bit more when it kind of comes to the small business side and the exemption we talk about a bit later as to why that is. But the fact that it's still regional is going to be somewhat difficult because a lot of issuers are going to be, you know, located out of Ontario, BC, somewhere across the nation, and that's going to be tough for them to do. And I think, unfortunately, from the dealer perspective, and particularly the exempt market dealer, because we're going to be talking about the non-listed issuers, I think, unfortunately, the statutory declaration is something that could be a little bit prohibitive to that, because you're going to see the professional sitting down with their client for an extended period of time, talking through the stuff that they have to do, like KYC and suitability, and then ultimately saying, okay, now take this package and go see your lawyer and go and get it notarized. And I think that that would be somewhat disruptive to it. The other side of this is that, you know, unfortunately, a lot of the exempt market dealers have had to move upstream to larger offerings. And for the most part, if they are going to be meeting with one of these clients, they would very likely already qualify through an offering memorandum exemption.
Right.
And if they don't, using kind of the minimum income stuff, minimum asset for eligible investors they're under, then the problem that they run into is, you know, suitability is a pretty high bar for the dealer world. And at what point is somebody still suitable for these high risk investments if they do have, you know, income test or asset test under that eligible investor threshold?
Right on. Yeah, I agree. I think that we'll see it used a lot in, you know, early kind of seed rounds where typically it's been friends and family and accredited investors only. But, you know, I talk about the young entrepreneurs that, let's say they, you know, worked for a company, they made a couple $100,000 a year, and then they left that company to go join a startup. They're now making $45,000 a year or $60,000 a year because they're taking some equity. And all of a sudden they can't make these investments in companies that they know well. So I think that that's a good target for this exemption. So the young entrepreneurs that really have experience in startups and understand the risks could potentially benefit.
Definitely. I mean, I think one of the most enjoyable things about the whole suite of exemptions that we're talking about today is that they all had their genesis in that, you know, Energizing Alberta's Capital Markets paper that came out, and each sort of serves a different demographic. And, you know, I applaud the ASC for taking that feedback to heart. Sometimes industry kind of thumbs their nose and says regulators don't listen. I think this is clear evidence that they do, because this exemption is very much in the space that you're talking about, Sandy, is that the venture world, the startup world. And we talk a lot about trying to build that culture of entrepreneurship, that startup culture in Alberta, and wanting to get that going to diversify our economy. But we're always focused on issuers, and this is almost like a way to incubate angel investors. And
Yeah,
that seems like such a great idea to me, as to how can we get people to move into that world
yeah.
rather than just focusing on the business side. There's the capital element. I saw an article a while ago where I think it was a law firm, so I don't want to pick on them, but they were talking about this as the fallen angel exemption. And I sort of felt like that was a bit of a misnomer. I mean, the fallen angel exemption sounds like people are going too far down the rung to get their capital. And I look at it as that rising angel exemption. These are the people that are going to go move into that space down the road. And this is a good way for them to learn, right down to, the investment acknowledgments, that when you look at it, you might say, well, that's a little heavy handed, right? There's 12 items just delineating everything
I'm
that
going to lose all my money. I'm going to lose all my money. I'm going to lose all my money. Yeah.
Exactly. But the flip side of that is, I mean, it's we have an exemption with almost an embedded crash course in risk. And that
Yeah.
seems to be actually a very prudent way to do this for the people that are coming into their own from an angel investing perspective.
Yeah.
So I think it's fantastic in that perspective. One of the things I was hoping that we could chat about a bit, Sandy, was the qualifying criteria. Um, because that's tough. Like, how do you build a demographic around this for who should qualify or shouldn't qualify? And this very much focuses on finance professionals and people with that sort of background. Any thoughts on whether or not that's sufficient? Because you see a lot of this from an investor
And
perspective.
yeah, for sure. I think the one challenge with focusing on the financial professionals is that many of those financial professionals have not had any experience in the private markets. So you're dealing with people that are, dealing in, indexed funds, securities that are traded on an exchange. So I think that's the one concern, is just because you're CFA doesn't mean you've had any experience in the private markets. So, kind of around entrepreneurs, people that have had their own business. I always say people have had to meet payroll. They understand what these businesses are like. So some expansion of that criteria, I think, would be well worth it as we start to see the use of the exemption.
Definitely. One of the parts that I love about this is the shift away from what I think is a kind of an outdated attitude towards, money deeming sophistication. The accredited investor exemption in large part is all reflective of, well, what's your income, what's your asset level,
Yeah.
how much money have you squirreled away? Um, and I think that's a little bit short-sighted. I don't know that that deems sophistication or ability to assess and accept risk. And so I think it's a really important thing that the ASC is doing by saying, well, maybe those aren't the right metrics that we should be applying, because they might not be accurate. And so moving towards, personal criteria, familiarity, and that ability to take stewardship of your investing decisions, I think is really important, especially as even within Alberta, I think we're now going towards financial literacy, even in our school system. I mean,
Yeah.
depending on
Well,
how
I
that's
think,
controversial, but
one of the other criteria of a suitability of an investment is the time to recover. So a lot of these are young professionals that have another 40 years of peak income earning ahead of them, whereas an accredited investor often is at a later stage in life. So that's another part of suitability. So if I have a long time to make up my $10,000 loss, there you go.
you raise an excellent point on that, especially when it comes back to your first comment about, the registered dealer world. Um, I don't think it's a secret that a lot of people in the registrant world are looking for income products, like a lot of their investors. And
Yield.
largely that's
Mhm.
reflective of demographic.
Right.
The very high net worth individuals are sort of getting into the point where they're not looking to take growth risk. And so they seek income. But if we can expand the client base to people that can accept startup risk,
Yeah.
based on age or otherwise, it could be effective. It's a good point. Um,
What about something that we'd want to change, Phil? Do we want to talk about that statutory declaration?
Yeah, it's gonna put me on the spot, so I'm start picking on things. The statutory declaration, I think is overkill. Selfishly as a lawyer, it's great. There's going to be people wanting to come see me so that they can get something notarized, expand your network that way. But I think that it's difficult. And with one of the tenets of this sort of being access across all markets in Alberta, I think it's a little bit tough for those in smaller or rural communities where
Mm-hmm.
you can't just turn around and find a notary,
Right.
or a commissioner for roles. And so that's a little bit tough. At the same time, I recognize that that formalization of the process is important. And the flip side is that the issuers, to a larger extent, can rely on the statutory declaration as opposed to having to familiarize themselves with the type of questions that they should be asking to ensure that they know it's true. The other one that I'm a little concerned about, and actually I'll pass this back to you, Sandy, is I think syndicates are a little bit tough with the way that this is structured. Um, as you know, a lot of the venture companies are looking to sort of bundle up these smaller investors into, a special purpose vehicle to
Yeah.
come in. I think there is some great headway made in allowing those to be not the public, so you're not jeopardizing the private issuer side. But I think the caps would still apply if a syndicate is there. And so the syndicate wouldn't be accredited on its own. And then to take that syndicate and invest more than $30,000 that's already been pooled could become
That
functional.
doesn't even make any sense. Yeah, right.
Yeah. But I mean, again, just as from a philosophical standpoint, it's such a great step in the right direction. And so positive to see regulators doing this sort of forward thinking stuff and challenging what the status quo was. And I promised myself I wouldn't do this, but I'm going to do it anyway. A little disappointing that this is just Alberta and Saskatchewan, quite frankly. I mean, I wish other CSA members were entertaining this, because even if we're starting at this point, it doesn't mean this is where we end. And down the road, it could be even better. But to just sit back and do nothing is wrong, especially right now.
Yeah, back to the ASC taking the lead. Gotta love that. And it is, it's challenging on any exemption across the country that is, unique to one province or one jurisdiction. So let's get BC in on it anyway. So Manitoba, BC, we can get the prairies going, and that'll be good.
Yeah.
All right. You know what? I think, Phil, you got one more thing?
I was actually going to ask how we were doing for time, so you read my mind.
You know what? I think this is we're ending on a high note. It's perfect. And you'll note, I'm going to say the sign of any good moderator is just to get the heck out of the way when you got good panelists, and that's what I'm doing. So awesome discussion and balanced and fair. So appreciate that a lot. So we are going to move on to the next topic, and we'll see you guys back here in a few minutes. All right, so Kathy Tiro, I'm going to pass it off to you to talk about the proposed blanket order, Alberta Small Business. Which order are we in here? I'm lost here.
So this is the small business financing.
Small business
Tom.
financing.
Yeah.
Small business financing. Gosh, Kate, take it away.
Yeah, great. Thanks very much, Tom. Yeah, so this morning, I guess it is morning, I'm going to be speaking with you all about the recently published for comment CSA multilateral notice and request for comment on proposed order. It's called 45-539 small business financing. And you can find this on our website as well under there's a couple of spots you can find it. So let's see here. Okay, so just starting off with just a brief overview of the proposal. So this is another joint initiative by the ASC and the Financial and Consumer Affairs Authority of Saskatchewan, the FCAA. So it would serve, if it's implemented, to hopefully streamline the financing process for startup and small businesses in Alberta and Saskatchewan. So as Denise mentioned, and you're all aware, in order to sell securities, you either need to do so under a prospectus or under one of the many prospectus exemptions that are available. And this proposal actually is a proposal for a new prospectus exemption that will allow businesses to raise up to $5 million from investors in Alberta and Saskatchewan, using what we're hoping is a more simple offering document that's got 2 tiers of offering and investment limits, depending on whether specified financial statements are provided to the investors. And it will allow businesses to raise money from the general public. By the general public, I mean people and companies who wouldn't qualify to invest under another specified prospectus exemption, such as the popular accredited investor exemption. So the purpose of this proposed exemption, so we're attempting to respond to some of these challenges, pardon me, faced by startups and other small businesses when they're trying to raise money. So one of the things we've heard consistently is that preparing audited financial statements in accordance with GAAP for publicly accountable enterprises can be a struggle for small businesses as they're starting up. Also, they have, they can't yet attract the interest of venture capital or the public capital markets. In Alberta, we've also heard from co-ops and corporations in small towns that it's very difficult to finance local projects. So we're trying to codify some of the discretionary exemptive relief that they've sought and that's been granted in certain cases. So in short, we're just trying to provide a tool for small business to graduate to higher financing amounts as they grow their businesses and have the means to provide that additional financial information to investors. So jumping into some of the more detailed components of this proposed exemption. So of course, there's an offering document requirement. So the issuer has to prepare and provide to investors this more simplified, streamlined offering document in a prescribed format. So similar to an offering memorandum that would contain, various details about the business of the issuer, the capital structure, the proposed use of funds, the directors and management of the issuer, some details regarding the offered securities, of course, risk factors when investing in that issuer's business, and financial statements if required. And I will talk about that in the next slide. Pardon me. So we've also created a fillable format in a more of a Q&A format style that we're hoping might simplify the process of creating this offering document. It's largely based off the offering memorandum format, but we've attempted to streamline certain disclosures and use more plain language in the way that the startup crowdfunding offering document went more plain language. And this is not required to be vetted in advance by the securities regulatory authorities, but it has to be filed electronically through CDAR within 10 days following the distribution, together with the report of exempt distribution form. So turning now to the financial statement requirements. So in what we're calling tier 1, which is issuer groups that raise no more than 1.5 million in a 12-month period, there's no financial statements required at all. In tier 2, when the issuer group raises more than 1.5 million in a 12-month period, the issuer has to provide investors with these specified financial statements. So what I mean by specified financial statements is statements that are prepared in accordance with Canadian GAAP applicable to private enterprises with some slight modifications. And the annual financial statements don't need to be audited if they've been subject to a review engagement by a certified public accountant. And just a note that when I say issuer group, I'm talking about any of the issuer and its related parties, so affiliates or other entities engaged in a common enterprise with the issuer. Okay, turning to offering investment limits with this proposed exemption. So in that tier 1, when the specified financial statements are not provided, so the maximum that an issuer group could raise in a 12-month period is the 1.5 million. And they're subject to a lifetime maximum of $5 million. And that's from investors who would not qualify to invest under another specified exemption. And I'll get to on the next slide what these specified exemptions are. In this tier 1, the maximum that an investor could invest would be 2,500 or 10,000, and that's in that 12-month period. And the 10,000 level is for what we've defined in the proposed exemption as a minimum income investor. So I'll discuss that in the next slide as well. So bumping up to tier 2, where the specified financial statements are provided, the issuer group could raise up to that aggregate lifetime maximum of $5 million. Again, that's from investors who wouldn't qualify to invest under another specified exemption. And then the limits for investors in tier 2 are $5,000 in the 12-month period, or $20,000 if they're one of these minimum income investors, as we've defined them. So turning to what these specified exemptions are, so they would be any of the accredited investor exemption, the close family, friends, and business associate exemption, the foreign investor exemption, or the self-certified investor exemption that Denise just spoke of. So just to be clear, so if there's investors that are investing in under any of those exemptions, any amounts that they invest are not counted towards those fundraising limits. So, and then as to the minimum income investor, so that would be generally those that have, for the last 2 years, had a net income in excess of 75,000 or 125,000 with their spouse. And then in the case of non-individuals, it would generally be people that are controlled, people or companies that are controlled by one of these minimum income investors. So turning to ongoing reporting. So in tier 1, there's absolutely no ongoing reporting required, no ongoing financial statements or any other reporting that is required. In tier 2, the issuer would have to deliver an undertaking in a specified form to deliver their annual financial statements, and they have to make them reasonably available to each holder of securities distributed under the exemption. But again, those annual financial statements can be those specified financial statements. So it can be ASPE instead of IFRS, and review engagement instead of audited. So investor protections are obviously always a key component of any proposed exemption. So there's several conditions that we built in an attempt to offset risks to investors. So one of the most important is that each investor has to complete an enhanced risk acknowledgement form in a prescribed format. So that actually has some details certain specific risks that are specific to smaller private companies, such as a higher risk of loss, lack of liquidity, the limited information that's available, including the possibility that there's no financial statements at all provided in that first tier, that the offering document hasn't been vetted and approved by any securities regulatory authority, and that there's likely not a registered dealer involved in these offerings. Of course, the limits are also very important to offset risk to investors. So we've got that aggregate lifetime limit of $5 million. And then the amounts that the investors can invest and potentially lose, that we have the differing limits based on that, the income level of the investor and whether or not those specified financial statements are provided. So just quickly, some of the other key elements of this proposal. So the issuer's head office must be in Alberta or Saskatchewan. So again, this is currently only an initiative of Alberta and Saskatchewan. We're hopeful that, you know, it could expand to other jurisdictions in the CSA, but for now it's just us. The issuer can't be a reporting issuer or an investment fund. And this exemption does not allow continuous distributions, so the offering has to be completed within 120 days. And if the minimum offering isn't raised, all the funds have to be returned to investors. And the securities distributed under this proposed exemption are limited to simpler, more basic securities, like common shares, preference shares, simple debt securities, units in an LP, membership shares in a co-op, and any securities that are convertible or exchangeable into any of those that I just mentioned. And very importantly, securities issued under this proposed exemption would be subject to standard resale restrictions, which would continue indefinitely until the issuer becomes a reporting issuer. So that's our proposal in a nutshell. So this proposal is just published for comment for the time being. So the comment period ends Friday at the end of the day, May 7th. So we would really appreciate if you have any comments to send them through. It doesn't have to be in any kind of a formal format. You can simply email them to new.economy@asc.ca, and we will happily take a look. In the notice, you will see that there's a bunch of questions listed at the end that we're specifically looking for some thoughts on, but we welcome comments on any aspect of the proposal. So thank you very much, and I'm happy to take questions.
Great, thanks, Kathy. I think you know this, but green is definitely your color.
I wore a green suit to match my green background.
Yeah, I see that now. It's well done. And just I'd emphasize that sort of emailing comments. You know, if you want to do a formal comment letter on letterhead, that's great. But for individuals, oftentimes, you know, just an email is easier. And when we publish them, you know, we do have to put the name of the commenter, but we'll obviously take out your email and that sort of thing. So some questions here. This question, why does the offering document state, in quotes, even if the securities are eligible for such plans, the investment is still risky. It is generally not recommended to use funds needed for retirement to make risky investments, end quote. The ASC has never taken on the role of suitability before. Why now?
That is a good question. I might have to take that one away and give that some thought. Denise, unless you had anything to.
I didn't quite hear the first part of the question, Tom. So it was saying it was a quote from the offering document that
Correct.
that it's a risky investment.
Yeah, even if the securities are eligible such plans, the investment is still risky. And I think it's the second sentence where it goes in and specifies. So it is not generally recommended to use funds needed for retirement to make risky investments. So, you know, risky is one thing, but I think that latter part maybe goes into suitability.
Okay, yeah, I mean, I think we have some general guidance on that and already, and I think you know, some of the materials that the ASC and other securities regulators put out on, you know, sort of investment considerations, you know, sort of touch on that. But you know, I guess we can look at that, you know, and see if there's any sort of tweaks to it. I mean, these are investments that are, you know, they're not liquid. They're subject to indefinite resale restrictions. There's limited ability to resell them, if at all. And it's sort of, you know, that early stage high risk space. So not something that you know, if you're looking at retirement in, you're going to need some to be able to liquidate something, you know, not something that's necessarily going to work well in that space. So I think that was what that was trying to get at. But, you know, we can, I can't remember that exact quote about plans. That doesn't sound familiar. So I'll have to look back and see whether there's anything to tweak in that.
Yeah, no, fair comment, I think, for sure. A couple of kind of related questions here. Sorry, Kathy, am I cutting you off? Did you have something more to add?
Nope, nope, go ahead.
Okay. If a registrant was involved, or pardon me, could these small businesses use an exempt digital platform, or could this exemption be used for crowdfunding offerings?
So I guess the short answer to that is technically yes. Technically, it could be used for crowdfunding. A couple of issues. The first being, obviously, it would have to be restricted right now to just Alberta and Saskatchewan. So they'd have to be very certain that any kind of portal would, you know, only allow Alberta and Saskatchewan subscriptions. And, you know, I think there's, you know, the way we're going with startup crowdfunding, it would likely be more appropriate that they would, you know, use the 45-110. I realize it's not yet in force, but when it is, that contemplates both prospectus and registration exemptions. If a business was to use this small business exemption for crowdfunding, they'd have to have a portal that was registered as a dealer, because there's no registration exemption contemplated. So I think it would be rather tricky. And we certainly didn't design this small business financing with crowdfunding in mind. I think we were looking at this as more networked raises, sort of beyond the friends and family, going to the next sort of circle of contacts, but not to the broad general public that's contemplated in the crowdfunding space. So that was a long, short answer.
Yeah, no, that's great. If adopted, these exemptions will need to be promoted in a significant manner to be utilized by the business community. Does the ASC have plans for outreach via Chamber of Commerce, etc.?
Yeah, that's absolutely, it's going to be key if this is simply sitting on the books and no one's aware of it. So we certainly do have plans to do everything that we can to get this out there. And I might flip that to Sandy and Phil for their help and guidance in terms of how we might best accomplish that. But we certainly are looking into different ways to get the message out there, not just on our webpage, but in doing outreach, maybe more of these webinar type, type forums.
Yeah, and I think that whole area of issuer and constituent engagement is very important to us in general. So yeah, the fast answer is yes, but again, the perfect segue. Sandy and Phil, please. Thanks a lot, Kathy.
Yeah.
Right on, Phil. I'll let you start on this one.
Way to ambush me with that. Yeah, well, it is actually the perfect segue because this exemption is very interesting to me. I actually really like this because it targets what I kind of view as the great ignored piece of the private capital markets. I don't think that this is the sort of exemption that is going to be used by typical startup companies, people looking to go public in the long run, guys working with venture issuers. I don't think it's going to work with the exempt market dealer network. And a lot of people would hear that and sort of go, then what's the point? And yet I think it's one of the most important that's coming out right now, because this targets that huge segment of businesses that probably didn't even realize that securities was an option for them from capital raising perspectives. This is sort of your neighborhood company, your local business that might look to be raising money. And I think there's an argument to say that now, maybe more than ever, this is fundamental. There's been a lot of companies that have just barely managed to get through the last, oh gosh, now what are we at, like 15 months, it feels like, with this whole pandemic,
Yeah,
scraping by with business closures, et cetera. They may have tapped out their lines of credit and done whatever they can. There is still the ability to raise money by distributing securities. But most of the exemptions and the entire market doesn't really pay attention to them. And this, I think, opens the door for them to be able to raise capital from within their networks. And I think that's huge. Too often when we talk about private capital, we go straight to the concept of hedge funds and Yale endowment models and all this really complicated stuff. But anytime you distribute a security, including promissory notes, you're within this regime, and getting that information out to people is important. I do worry, though, that uptake and traction is going to be really slow,
yeah,
because most of the people, probably even on this call, and I don't mean to pick on our audience, but they likely might not be using this. It's other businesses that didn't even know to be on this call that are looking for
correct.
it.
Yeah.
And for me, then it's about getting the information out to small law firms, small accounting firms and boutiques, business support networks, and that sort of thing, to let them know that this is viable. What are your thoughts on that, Sandy?
Yeah, I agree. The early stage venture space is supported by accelerators and incubators and all sorts of angel groups giving entrepreneurs some information on how they can raise capital in a venture type business. So let's call it, these are lifestyle businesses that this, I think, really can work well with. You've got a great customer base, your customers love you, they want to feel part of your business, and you can reach out to them. But how do these companies learn that? Because there isn't that ecosystem that's supporting that. So the chamber is a really good idea. I actually sit on an advisory council with the chamber, and that's a really good idea that Craig put up in the questions. And also, we talked a little bit about ATB. Like, why not ATB and BDC, who are sometimes providing debt financing to these early stage startups, let's call them, not even early stage, but real small businesses. That's a good market too, to get them educated on how equity could support some debt that the companies are taking on.
Yeah, and not that it would be my place to do a call to action on this, but for everybody that is watching that this isn't their space, at least be aware enough that it exists, because a lot of times it's, the venture groups or the dealers and, the big law firms, they'll get phone calls from somebody with this question and they'll kind of go, this space isn't for you. But now it might be. And so just direct them in the right way. Tell them where they can go to get that information, because I think this could be really impactful for some businesses that have suffered for too long and may have a venue other than, traditional bank financing that can sometimes close the door.
So it's a lot about education. Let's make sure that the right people are aware that this is possible, right?
Oh, big time. The offering document, Sandy. I mean, that's sort of the one thing that makes me a little bit spooked, is on the one breath we're saying that small businesses, your neighborhood restaurant could use this to get themselves through tough times. I mean, granted, there's a whole bunch of risk, and that always needs to be entertained by the investor, but it's an opportunity for them. But there's still a rather complex document that they have to get over, and that's a hurdle to being able to do it. Do you think they're going to be able to navigate this?
Well, funny you ask, Phil, because we gave the document to a couple of young entrepreneurs to see if they could actually complete the document. And there was obviously a lot of things in it that they weren't exactly sure how to answer. So this begs for, back in the day, I said we should have an OM generator that's going to create these documents. So it was a little complex with an OM, but maybe there's, some technology can support this. And just by answering some questions, it could actually start to complete that document. So a few of my legal tech colleagues out there might have an opportunity.
It would be really interesting if somebody could figure it out. It is tough. I mean, the offering memorandum reference has gotten so complicated,
It's like a prospectus now, we keep saying, yeah.
prospectus light that they're doing, and just even the nature of language choice from within that to make sure that you're not getting into the whole misrepresentation world that is also heavily regulated. I would be curious if there's, I don't know if amnesty is the right word, but a certain amount of forgiveness even from the regulators with respect to that use of terminology, where
Mhm.
inevitably you will see small businesses not word this the way that the national law firm would have, but an acknowledgement that that may still be acceptable. I mean, quite frankly, it would actually be nice if that trickled back towards the big firms and people
Right.
started plain language as well.
Because it is normal people that are trying to read those documents, right? So they're going, well, I don't know what that means. So yeah, I do agree with that. I think that this, I'd like to see this move forward clearly with the ASC. But I think that the community itself will have to kind of band together to ensure that people are aware of how they can raise capital this way, and really just getting it out, as you said, to those lawyers and bankers and accounting firms that are dealing with these businesses all the time.
Yeah, and I don't think we should be discouraged by slow uptake with this one. I do say that if it takes a long time, I don't think that means it's an abject failure. I mean, there's always room for tweaks and changes, but I would wait for this to sort of percolate out. You know, I I always jokingly call the private issuer exemption the accidental exemption. A lot of people go in and out of it without even knowing that they should have been looking at the Securities Act. Every corporation that issues shares is distributing securities, just it's going to the founders, it's all fine. Um, and this is going to be sort of like this is an add-on to that accidental exemption, but they have to be active in pursuing it now. So letting those groups know there are opportunities out there, and it'll take a while, but I think it could be really big. And all those small businesses can become big businesses. This is the most important demographic that we have economically, and it's important that we cater to them.
I agree.
Eh, What about the financial statement, Sandy?
So, I struggle with the financial statement side of things. So, first of all, as we all know, corporate law probably dictates that you're supposed to be sending financial statements to your shareholders anyway. But to make it a requirement to say I'm going to send financial statements, what is the investor supposed to do when they get them? I mean, it's like if you're a public company and you get the financial statements, you go, wow, that one's gone south pretty bad. I think I want to sell my securities on the exchange. You can do that. But I don't really understand the point of now I get the financial statements. What do I do with them once I get them? That would be my only comment. I think it's great practice for companies to ensure that they keep their financial statements up to date. And there is corporate law that will ensure that you get them to your shareholders. But maybe it's just good practice for the company, and maybe that's just what it needs to be.
Yeah, I mean, it's the closest proxy to a valuation that you can get when something's not traded. I mean, it's completely useless for the average person to try to digest that and translate it to a market value.
Right.
But, I think it's the nearest that they have. So I agree with you. I think it's got pretty limited utility. And I can say that until I had to start looking at these when preparing offering memoranda, I couldn't read financial statements for the life of
Well,
me. So
neither is the investor. I agree.
so I'm not sure about its true utility, but I guess if people do learn to use them, maybe it helps for future planning to know
Yep.
that, I bought this thing
Mhm.
and it's not going anywhere.
And
And
good governance for the company, right?
for sure.
So I think that's good too.
Yeah. One thing that I struggle with this, and the crowdfunding question asked by the audience was interesting because I didn't like that the crowdfunding exemption was so specific about the use of technology. Our regulators sort of say that they want to be technology agnostic, and then the crowdfunding opportunity was solely if you used a portal. And I think this is great because we say democratizing things, we always mean use of technology, but I think the true democratizing is not forcing you to use technology. And that's what this does for people. So I like that. But the one thing that both of these fall prey to is you look at those caps. And if I raise $1.5 million and I'm getting $2,500 each, I'm talking about 600
I
investors.
know, I know, I
That is
know.
a wildly unwieldy number of investors. And for the people that are on this call that might have funds, like they know what it means to have a
Yeah,
huge number of investors. It's tough.
yeah. Yeah, I agree. I think caps are challenging, and particularly at $2,500 for a $1.5 million raise. I had my team do that calculation, and we all came back and went, wow. So, hey, that's why technology needs to support you, because trying to get subscription documents from 600 people is pretty tough. But I do think that is challenging, and it, if you're doing your raise with accredited outside of it, it doesn't count in the 1.5, right? So you still could potentially raise 1.5 to $2,500 at a time.
Yeah. So that'll be tough. And then what I thought that would do, and maybe Sandy, you agree, is it's very likely that most people will raise far less than 1.5
I
or $5
agree.
million using this.
Under that exemption.
Yeah, because of that very reason. And so I think we need to sort of dig deeper and say, okay, well, is the level of disclosure still reasonable when you assume that people are going to be raising $100,000, $200,000? And at that point, is it too expensive for them to go this process?
Yeah, that's a fair comment for sure.
Okay, I'm gonna maybe just jump in here. Seems like we're at a bit of a pause. Again, great discussion. And if there's any kind of suggestion that we only invited people that totally supported our proposals, I think we've nipped that in the bud right now. So anyways, thanks guys, great discussion. And now I'm going to turn it over to Navdeep Gill, our manager of the legal group and market regulation, and he's going to talk to us about the small business finders exemption. Navdeep.
Thank you, Tom. I'll be talking about ASC notice and request for comment of proposed blanket order 31-536, Alberta Small Business Finders Exemption, and revocation of blanket order 31-505. So why do we need a finder's exemption, and who exactly is a finder? So when we refer to a finder, we typically mean somebody who makes an introduction between an issuer looking to raise capital and a purchaser looking to invest. And if there's a trade that's completed, that finder will receive a finder's fee. That's who we mean when we're talking about a finder. And under our current rules, finders that are engaging in that type of activity often will trip the registration trigger and be subject to the dealer registration requirement. And that's because even in doing that very simple activity, they're often engaging in activities similar to a registrant, intermediating trades, acting with repetition, regularity, or continuity. They're being remunerated or compensated for the activity, and they're often soliciting for investments. So we recognize that when you become a registrant, there are significant costs that come with that. Some notable examples are the requirements to file audited annual financial statements with the regulator, complying with ongoing working capital requirements, and also maintaining insurance requirements. So the concern from the regulatory perspective is recognizing that finders play a useful role in the capital markets. There might be some finders who choose not to get registered and not participate in the capital markets at all. So the whole goal of a finder's exemption is premised on keeping finders in the capital markets, but limiting their activities to only truly acting as finders and not going beyond that. The exempt market dealer category of registration was implemented by the CSA on September 28, 2009. Now, prior to the implementation of that category, there were a large list of exemptions from the registration requirement that mirrored the exemptions from the prospectus requirement. With the implementation of this new category, most of those exemptions were revoked and repealed. As a result, intermediaries went from a world of being mostly exempt from registration to now being caught if they're in the business of trading in securities. There was a concern at that time that this may have an adverse effect on capital formation because a lot of these people may not choose to get registered. In response to this concern, the ASC implemented blanket order 31-505 on March 27, 2010, which was an exemption that was targeted at finders as long as finders complied with the terms of that order. After a public consultation and examining this exemption further, on March 11, 2019, the ASC issued a notice indicating it would be keeping that exemption for now, but would be considering alternatives to that exemption. And that's what brings us to proposed blanket order 31-536. It's our view that this is an exemption that's better for finders because it will enhance investor protection and it will better integrate with the existing and proposed prospectus exemptions that small businesses in Alberta can rely on. So in our view, this is an enhanced finder's exemption. So under this new exemption, which issuers can a finder act for? The issuer must have a head office in Alberta, and the issuer must not have raised more than 5 million under exemptions from the prospectus requirement. Based on some preliminary consultations we've done with our exempt market dealer community, we've learned that many exempt market dealers will not even participate in financings that are less than $5 million on the capital raise. So in our view, this finder's exemption might help fill that gap. When can a finder participate in a financing? So the issuer must be relying on one of the following exemptions from the prospectus requirement in NI 45-106, the accredited investor exemption, the offering memorandum exemption, the minimum investment amount exemption, or when a private issuer is making a distribution to an accredited investor or a person that is not the public. Furthermore, the issuer can be relying on some of our new prospectus exemptions that we've talked about today. Blanket Order 45-538, self-certified investor prospectus exemption that Denise has explained, and proposed Blanket Order 45-539, small business financing that Kathy's explained. So in this way, this is where all three of these ASC initiatives really come together, because now issuers will have a greater number of prospectus exemptions available to them, and finders will be able to participate in a greater number of financings. So from our perspective, that's why we've really prepared all three of these initiatives together and worked on them in conjunction with one another. So under this new proposed finder's exemption, who can be a finder? The finder must be an individual being a natural person. The finder can't be a corporate entity. In ASC notice and request for comment, we've actually asked a specific question on this point, and we'd like input on whether the finder should allow to be a corporate entity in addition to being an individual. Also, the finder can't fall within with a new bad actor disqualification that we've built into the exemption. Essentially, a bad actor would be somebody who has been sanctioned within the last 10 years by a regulatory or administrative body in relation to a matter related to fraud, theft, or deceit. So if you've had that type of sanction, you won't be able to rely on the new finder's exemption. What can't a finder do? So a finder cannot be a registrant. If somebody would like to act as a finder as a registrant, that is permitted, but then you also have to comply with all the registration requirements, some of which we talked about earlier. So you have to choose your path. Either you can act as a finder as a full registrant or fit within the exemption. You can't have a foot in both. The finder cannot provide suitability advice about the security. Now, the finder is permitted to provide a factual overview of the offering. What they can't do is learn about the individual financial circumstances of the prospective purchaser and try and explain why this particular offering is the right investment for them. That's prohibited. The finder cannot publicly advertise the offering or solicit purchasers without having a substantial pre-existing relationship with the purchaser. So some examples of this would be the finder cannot make offerings available online over a portal, and the finder cannot speak to a room full of people about an offering that they don't know. They have to know the people that they're making the offering available to. The finder also cannot hold or have access to the purchaser's assets. Also, the finder cannot have had one of the following relationships with the purchaser. They can't have acted for them as a registrant other than in relation to the sale of a security in relation to the prospectus exemptions that are set out in the order. They can't have acted for them as a financial planner, an insurance agent, a mortgage broker, or have had a similar financial services relationship. The reason for including this prohibition in the exemption is the concern that the regulators are trying to deal with is whether someone will use the trust they gained in providing these types of services and try and use that trust now to make an offering available in the exempt market. On the flip side, we also want this exemption to be used widely. And for that reason, we've actually also asked a question in ASC notice and request for comment on whether this prohibition is appropriate and whether the list of occupations that are listed are appropriate. So we would appreciate your input on this point. Some other requirements pertinent to the exemption are as follows. So the purchaser must be a resident in Alberta, and the finder must obtain a signed risk acknowledgement form from each purchaser at the time of the transaction. Some of the key aspects of the risk acknowledgement form that the purchaser must acknowledge are as follows. So you must acknowledge that you understand the finder is not a registrant. The purchaser must acknowledge that they have a relationship with the finder. They have been provided with suitability advice. They understand the finder is being compensated for the trade. And as a result, they have an inherent conflict of interest. The amount of the compensation that would be paid by the issuer to the finder must be included in the risk acknowledgement form, and the purchaser must acknowledge that. The purchaser must also acknowledge that it might be helpful for them to seek advice from a registered dealer or registered advisor, and also that they understand this is a risky investment. The finder is required to obtain 2 signed copies of the risk acknowledgement form, one for the purchaser, and they must keep one for their own records. So if the ASC does do a review of an individual that's relying on the finder's exemption, we definitely would look at these forms. Also, it's a requirement in the exemption that the finder must file finder's information report with the ASC. These reports will be filed with us electronically, and they will allow us to track the names and contact information of all the individuals that are relying on this exemption. So again, that would give us the ability to do compliance reviews as needed. Lastly, there also is a transition period in the exemption. The way the transition, and that's a transition period from the old finder's exemption, blanket order 31505, moving to the new proposed exemption. So if there's private placements that are already underway, there would be a 6-month period provided by way of transition to allow the finder to complete those. But all new private placements would have to be under the new finder's exemption. The request for comment will remain open until May 7th. As a regulator, we're trying to strike the appropriate balance of ensuring adequate investor protection, but also, as I mentioned, make the exemption useful. So to do that, we do need your input, and we would greatly appreciate your comments. Please send your comments to new.economy@asc.ca. Questions?
Perfect timing, Navdeep. Thank you. One question here. There's a lot of comment about what you can't do. What can a finder say to a potential investor?
So a finder can provide a factual overview of the offering, and that must be factual. Where the finder would get offside is if they try and link the offering to the individual circumstances of the investor. That's when that starts to cross the line of trying to argue this is a suitable investment. In our view, that's activity more appropriately done by a full registrant that has certain proficiency. So in answer to that question, Tom, it would be providing that factual overview of the offering.
Okay. Question: will all trades still need to be done by an EMD?
So EMDs certainly can participate in these offerings, but if EMDs participate, then they also must follow all the rules that apply to registrants. This is an avenue for a finder to be able to act under an exemption from the registration requirement, to not have to register as an EMD, but still participate in the capital formation process. So EMDs have the option of acting, but we've given market participants an option of acting as a finder and not have to register as an EMD.
All right, this is a quick one. Does this replace referral agents who refer to registrants?
It certainly is a little bit different, and the term referral agent sometimes can mean different things to different people. I think from the regulator standpoint, if it's a clean referral where you're just providing a name and a number and you're directing an individual to an issuer, that activity may not even be subject to the registration requirement. And this exemption is only needed if you're actually tripping the business trigger and you're subject to the registration requirement. So I think many referrals may just fall outside of this. But if you do have somebody who's acting as a referral agent that's exceeding certain thresholds of compensation and they're operating with more regularity and continuity and they're starting to trip that business trigger, then they may want to look at an exemption that might work for them.
Okay, and this question kind of ties back to the earlier questions on crowdfunding. Can this exemption be used for online crowdfunding?
It can't. There is a prohibition not to market generally. So this won't work for crowdfunding. However, the CSA is working on a crowdfunding rule, and we've already talked about it. It will be National Instrument 45-110. It was published for comment in February of 2020. And hopefully later this year, we can get a final rule out. So this exemption won't work for that, but there might be another exemption coming online very shortly.
Okay, that's great. I think this is a good time again to pass it over to our industry panel. And Phil, I know you might have some particular thoughts on this in terms of your involvement with the Private Capital Markets Association. But anyways, I'll let you guys run with this.
I appreciate that. I may pause and let Sandy start us off on this one before I do my requisite rant.
Technical difficulties.
There you go. So this is an interesting one, and Navdeep, I haven't got as deep into this one as I have the others, and I intend to do so today. But you know, people are saying to me, is there a need for a finder's fee in helping early stage companies access capital? And you know, that is a really good question. I think that at the very early stage, particularly at the very early seed stage, companies just are so ill-informed on what their options are and how they need to comply and all of the regulations around raising capital. So I can see that there would be value for someone who would help them navigate that, ensure it gets, you know, structured in the right way, and then goes out to their own network to say, I've got a network that wants to support early stage companies, particularly in this niche. I can see it working in, you know, legal tech for lawyers, in med tech for physicians. So, you know, there's a potential that I could see that an early stage company may want to, you know, get involved with someone that can help them navigate the whole process. What do you think, Phil?
So I'm conflicted on this one a little bit, but I want to say I unequivocally think that this is necessary, which might be a surprising answer, considering that a lot of my practice is with the registrant world and kind of dealer. But we really need this, and it's almost an issue of privilege. As weird as that sounds, I mean, there's unfortunately the fact that if you go out there looking to raise capital and you weren't, you know, raised in the country club where
Right.
you know a whole bunch of people with a ton of money that qualify as accredited investors, it is really tough to get money. And yet the people that tend to have a monopoly on access to capital don't have a monopoly on good ideas. And so I think we have far too many people, whether they be young Canadians, new Canadians, people outside of, you know, major centers of finance, that can't pursue whatever their entrepreneurial dream is because they can't get money. And the
Yeah, I
ability
mean,
to outsource it is huge. So I think on
yeah.
that basis, we need it. Go ahead.
I totally agree, Phil. I mean, I think we always say in the venture space, you know, any good company will get financed, right? That's just what everybody says. But the reality is there's an underserved market, like you said, new immigrants, women. Certainly there's, it's tougher for some people to raise that capital. So having someone who has some awareness of who's interested in that type of business, I think could be very helpful. But now, Phil, you take the other side of it.
You know what? The other side is that, so I want to say, like, I support this. I think it's necessary, and I think it's going to be really impactful for our economy to allow people to access funds. What I find heartbreaking is that it's necessary. Because we talk about the fact that the exempt market dealers are not raising capital for issuers south of $5-10 million. And yet we're not digging into why that is and seeing if we've built a problem that we're now just trying to put a Band-Aid on. And that sort of disappoints me. I mean, you look at the exempt market world, the dealer world in whole, and they've got, you know your product, know your client, suitability, duties of care, conflicts of interest, all things that are wonderful and are supposed to help protect investors. But the cost of the compliance and the way that it's being administered has forced all of those dealers upstream, and they're ignoring this other demographic that needs capital. And so the solution to the problem is almost like a throw the baby out with the bathwater approach, right? Like, why are we saying that investors should not be afforded any of those protections of KYC, suitability, conflicts of interest, duties of care, proficiency, and just go to somebody who's not registered and doesn't have to do any of that? I mean, it's a real fox in the hen house to me. Whereas I would much rather see something come from the CSA, and I acknowledge that the ASC can't do this on its own. So again, I'm sort of pointing at the other regulators out there saying you got to look at this. There has to be a way for EMDs to make their own compliance sufficiently economical that they can actually help people. They can help companies raise money, but at the same time, they can help investors with ideas like suitability that are so beneficial in doing this. So that's what bugs me about it, I guess, is I think it's necessary, and I don't for a second think that you should do this. But I really hope that the CSA at large starts looking at why it's there in the first place and realizing there's probably better solutions.
Yeah, we just made it really hard for EMDs to participate in this space just because of the size of the capital raises. And then, typically their audience of investors has been more to yield, as we mentioned earlier, right? But that doesn't mean that there wouldn't be an exempt market dealer out there that said, I'm going to be the best venture capital exempt market dealer out there, and still be able to have some different regulations around how they do that. So I hear you on that, Phil. I just know that typically today, it's not a space where EMDs are wanting to play.
No, and I think it's, in the startup space, everyone likes to talk about minimum viable product, but, I think we need to also look at minimum viable regulation, and whether or not things like statutory declarations and acknowledgements can supplement that enough to at least make sure that investors are getting, sound advice, and not allowing people to dust their hands and say, oh, legally, I can't tell you if this is a terrible idea, but I'm still getting paid. And that's a little bit dangerous to me. But at the same time, go ahead.
Yeah, I was just going to say that the comment around the factual review of the offering, but not providing any advice on it, is interesting, because if you look in the angel community, we talk a lot about risks, and you shouldn't do this if, and your portfolio shouldn't be all this risk. So I mean, that's just what the community speaks to. So for a finder to not say this is not recommended to be 100% of your portfolio, and that deems to be advice, might be a little challenged.
Yeah, Tom, you look like you were going to say something there. Oh, but I mean, I don't think we can solve it. So, I just want to raise the point that I think it's an issue. At the same time, we need to make sure that those that don't have a network of high net worth individuals in their back pocket have the ability to outsource that function, because I think otherwise we probably have far too many ideas and businesses in this province being underfunded just because of the demographic that the entrepreneur comes from. And I'd rather solve that first and then solve the second part after.
Right on. I agree.
Maybe just, and Phil, you've kind of alluded to, bigger picture wish, but on this particular proposal, one wish from each of you, maybe?
Yeah.
I'll start. I'm not sure why we're recommending individuals only and not corporations. Just how tax laws are set up, it's easier for someone to have an assistant and pay an assistant and do that under a small business. So that would be one that I would say in the comments to ensure that's forward to say, is it really realistic for this not to be available to corporations?
Yeah, I mean, I haven't thought it through to know if this is even a reasonable thing, but while I accept that maybe the finders shouldn't be talking to investors about whether or not the product itself is suitable, at minimum, to help protect those investors, I'd be interested if they had some duty to sort of talk to their recipients, I don't know if you call them clients in this case, about whether or not the space is suitable.
The asset class.
Yeah, the asset class. Thank you, Sandy. Like whether or not the absence of liquidity is right for you in the absence of a reporting issuer. Because, I mean, there's nothing that would stop one of these finders from selling, a long-term growth product to somebody who is 90. And yet that wouldn't make any sense. So whether or not the product itself is going to succeed, I get that they shouldn't advise on that, but what about just being there in the first place?
All right, you know what? I think we're at 5 to 11 here, so I think this is a good time to wrap. So just in general, just a couple of things. Just want to encourage people to comment on the last two items that are, still up for comment. Blanket order 31-536 and blanket order 45-539. Send those two. There it is. New Economy at asc.ca, and like I say, email, letter, what have you. And I just want to reiterate the comments today, or pardon me, the questions and comments that have been submitted. I should say that there's been some really good suggestions submitted in the questions. We appreciate those, and we'll put it into a format so that everyone can see what the answers were. Denise was answering them, some of them offline. But we'll get that out to the broader group. Sandy and Phil, thank you again for participating. That was just great to have some, people can listen to regulators only so long. So to get your industry experience was super helpful. As I was listening today, obviously today, a lot of it was focused on the sort of private capital market, although certain elements of these exemptions can be used by public companies. And so I know a lot of people on the call today are with more in the public space, and I don't want you to think we're trying to play favorites here. These are a group of the exemptions that we're trying to get feedback on and exposure to, and our view is that if we can put more tools in everybody's quiver, that's going to benefit everybody down the road. There's some great products in the CPC and things like that everyone knows about, and there are some more proposals coming for public companies here in the not too distant future, and so we'll keep people apprised of those. So I just wanted to throw that in. Thank you all for attending, and I think we're going to close for now. Stay well, stay compliant, and stay tuned. Thank you.